Welcome, everyone. And on behalf of FrontierView, thank you for joining our webinar series. On today's webcast, we'll be discussing our events to watch in 2021. This is our annual flagship analysis of the key potential global disruptors that multinational corporations should be evaluating as they prepare for the coming year. My name is Adam Jarzik. I lead the APAC research team at FrontierView and will be moderating the discussion. I'm delighted to be joined today by Ryan Connolly, who leads our research on global economics. Before we get started, we realize that some of you may be new to FrontierView, so I'd like to take a minute to provide you with a quick overview of our firm and how we support multinational executives. FrontierView is a premier global market intelligence and advisory firm. Our primary focus is on serving the market intelligence needs of global business professionals at multinational corporations by informing and powering their market monitoring, strategic planning, and international growth priorities. From the beginning, we built FrontierView to be different in three primary ways. First, our product and service model has been purpose-built to serve a global business audience. In every aspect of our work, we strive to separate signal from noise and answer the so what, now what questions that are unique to the international business professional. Second, our model, which we call Strategic Intelligence as a Service, is the only market intelligence solution that bundles together information resources, analyst advisory services, and senior executive network events into a single offering. Finally, our world-class technology, which powers the FrontierView desktop and mobile applications, and has been built with the sole purpose of informing our clients' workflows and decision processes. We are incredibly proud of our client base, which today includes a community of over 4,000 global business professionals and is growing rapidly. You can see a sample of the companies we serve here. If you're not a client and are interested in receiving complimentary trial access to our FrontierView program, please request a trial in the comment box or visit our website, www.frontierview.com, and click the Request Trial button. Having briefly introduced our company, I'd like to take a moment now to introduce our presenter. Ryan Connolly oversees global economic research for FrontierView and supports clients on strategic planning, market prioritization, risk identification, and contingency planning in their most important markets. Before joining FrontierView, Ryan worked at Morgan Stanley on a special situations desk. He holds a bachelor's degree in international relations and affairs from the George Washington University, as well as a master's degree in international economics from the Johns Hopkins University School of Advanced International Studies. As a reminder, before we move into the content, you're welcome to submit questions by clicking on the Q&A button of the GoToWebinar application on the right-hand side of your screen and by typing them to FrontierView Webinars. If there are any insights you see today as part of this discussion or any questions we don't get to answer, our client services team, Sarah, Raveen, Althea, and Yuchen, will be happy to follow up with you directly. And with that, I'd like to turn things over to Ryan to take us through the agenda.
Great. Thank you very much, Adam, and thanks everybody for joining us at this morning hour in Singapore or wherever you happen to be dialing in from. I'm based in Washington, D.C., in one of FrontierView's many offices to deliver this morning, this evening, this afternoon, our events to watch for 2021. The agenda is pretty simple. We're going to start out with quite a bit of detail around kind of what you consider our base case around COVID-19 and the fate of the global economy in 2021. And then as we sort of transition further and further from the base case to some of the operational uncertainty in the short term, we'll pivot into the sort of events to watch for 2021, which is a lot of our event risk style events that we sort of deal with every year. And then at the end of that, we will have some Q&A. And I do encourage everybody to submit questions as they come up, and we'll try to get to them at the end. And if we're unable to answer them in the call, we'll follow up afterwards via email. So base case views around COVID-19 and the global economy. We have a very diverse risk picture as we enter 2021. And I think this is important to note, regardless of job function. If you're a country manager in charge of managing distributors, supply chain, going all the way up to sort of in the strategic centers of corporate headquarters or in the global office, The risk picture is extremely complicated in 2021, and that risk picture has many different elements, as we all know. There's obviously reputational risk during a time like COVID, during a lot of political turmoil in the world. There's obviously execution risk as it comes to actually being able to enact strategic plans that were made due to anything from COVID disruptions to event risks. There's supply chain risks and pricing strategy problems that we've all encountered in the last 6 months. And then just as another thing to note here is that strategic plans that were set in 2020 for 2021 are unlike strategic plans that have been made in the past. When they were made, there's a lot of uncertainty baked into those plans. A lot of companies have shifted from an annual plan to quarterly planning, to different forms of setting sales targets, to more flexible planning arrangements. And we've heard everything from more localization of targeting and oversight down to regional headquarters, down to country level managers, all the way to the other extreme of more centralization. So every single corporate experience here is going to differ substantially as we discuss some of the management pressures you feel. Part of the point of this report is both to support sort of global managers, sort of C-suite level and just below, with understanding the risk picture, the possible disruptors to strategic plans in the name of contingency planning operations. Equally, part of the purpose of this exercise is to provide those in regional offices, country offices with sort of functional oversight programs to understand what corporate HQ is worried about as they report back up and as they design their own mitigation strategies as we go forward. And so this report is very much designed to help to assist everybody with the thinking process of the risk picture. So again, this year is a bit unique in terms of the amount of focus that we have to put across the entire organization on COVID-19. So in the first part here, what I would say is there are risks directly related to COVID-19, and we are all aware of that as we go forward. Much of APAC, China specifically, South Korea, Taiwan, has the virus relatively well under control. Other parts of Asia Pacific, control is much less sort of established. And then obviously, if you're talking about sort of global planning, there's parts of the world, including the US, where COVID-19 outbreaks are basically running rampant. And so we're still worried about some of those factors that we were worried about back in sort of February, March, and April of last year. Case levels rising beyond hospital capacity, very sort of volatile local rules and restrictions, with rules being enacted sort of overnight with uncertain application and then lifted just as quickly as cases started to fall. The impact that has on local services demand, and then of course, how effectively vaccines are rolled out, the efficacy of those vaccines. And all of that is important for understanding sort of the arc of local services demand, consumer demand, and how normal business activity is across 2021. We're going to go a bit more into that in a second. Your sort of second big bucket here in orange is indirectly related risk to COVID-19. So here we're talking about sort of the economic fallout. If you have large upticks in cases, resumption of local restrictions, that's going to have an impact on the economy, right? And so your economic outlook is going to suffer as a result of that via that linkage. So that's the immediate one that we'll discuss at some length. And we've seen significant forecast moderate alterations as a result of that already, with Western European forecasts falling as a result of the outbreaks there and the longer lockdowns. And obviously that has industry-related risks as well. So tourism and travel, that recovery really hinges upon the effective control and containment and vaccination schedule. We also have other risks. So sort of the fiscal debt load, debt risks, and the fiscal outlook for some of the emerging markets with less access to capital. Will we see a return of sort of austerity type politics that pulls back government spending, reduces government procurement in order to address the size of the debt load, which is perceived as risky in some cases. And of course, political dissatisfaction. For societies that have been under lockdown, in some cases with big increases in unemployment, inability to sort of enjoy local services, as well as the potential cuts to social spending that might come as countries try to get the fiscal problems under control. And those are all indirect risks that are certainly weighing on the minds of corporate planners in many geographies. Latin America would be the main one for that one, parts of sort of Central and Eastern Europe, and also parts of APAC. And then finally, event risks. And that's normally the focus of the events to watch, is these sort of very high impact, low probability events that we think are necessary for corporate planning, both to make sure that you're not caught by surprise, so contingency plans are enacted, but also so you have the right networks embedded within your organization to respond to those events as they occur. In a way, it's trying to prepare for the unlikely but potential events that could have a massive impact on really corporate margins at a significant level. And we will talk about a few of those today, and we'll show you some of the others that we've pulled up in our events to watch for this year. So the evolution of the US-China conflict is obviously one that's top of mind, as we have the new Biden administration coming in, as well as sort of the international policy shifts unrelated to the US-China conflict that the Biden administration might implement. Things like a green agenda, which could have an impact on industries as well as country trade flows, as well as things like targeting currencies for manipulation, things of that matter, buy American policies that could limit the sort of market competitiveness of firms that have been selling into the government. Major pricing swings, oil, cyclical, metals, and food are probably the top three that we're talking about recently, as well as currency swings of a significant amount. And so we'll discuss some of these event risks as we go down the loop. But you can see the corporate planning problem here is that there are very clear immediate risks posed by direct impact of COVID. There's the very clear uncertainty around targeting, which comes from the indirect risks, and then the event risks, which could have a massive impact on business plans. But corporate planners have been so focused on the COVID risks in the short term that the event risks are to some degree going underappreciated, or they haven't quite gotten to them in their normal sort of calendar, and they might be coming up in sort of second quarter review processes. And so we're going to build into those. So in terms of COVID, we've seen a relatively slow start to vaccination. Now, vaccine rollout began roughly on our targets. We expected initial vaccine rollouts to endangered groups and sort of medical professionals, frontline workers, to begin in developed markets in December of last year, and that's basically when they started. With the exceptions of Israel and the UAE, vaccine rollout in most developed markets has been relatively slow. But what we do know is we have at least 2 vaccines with over 90% effectiveness rates. Other vaccines are coming up with between 15 to 80% effectiveness rates, and there's a lot of vaccine supply. And so we do think that for a large portion of the developed world and even a large portion of the developing world, we're going to have widespread vaccination, effectively herd immunity in some of those countries, going into the second half of this year. And the main impact that's going to have, which we'll touch on briefly, is a very robust and rapid recovery in demand for locally produced and consumed services. So we're talking about a recovery in the food services sector. We're talking about a recovery of domestic tourism for sure in countries that don't have that yet, leading into a moderate recovery in international tourism, though it's a few years off for a full recovery. But certainly domestic vacation tourism is going to rebound very sharply. And we're already seeing that in forward bookings and pricing pressure. But up until you have sort of widespread vaccination that leads to herd immunity, we continue to have COVID-related disruptions on local activity. We've used this framework before, and it's a variant of what's called the hammer and the dance. But basically, in the initial wave of COVID, that vertical axis is daily new cases. The big spike in daily new cases led to social restrictions, local restrictions, consumer behavior in terms of wearing masks, sanitizing. And then that led to the break of the first wave of COVID. Following that wave, we had subsequent waves that were mainly tamped down by government officials by reimposing restrictions. We had at least 3 waves in the US, 2 big waves in the Western Europe and Canada. And it's because we understood the disease, we knew what kind of policies to put in place, consumers knew how to protect themselves. What we see now is a widespread outbreak of big third waves, partly related to the mutated strain of COVID, which, while it does appear that it does, vaccines do prevent it, it is much more infectious, and we haven't fully figured out how to prevent those waves from really breaking the curve. So we've seen very onerous restrictions put in place in large parts of Western Europe. Angela Merkel said 2 days ago that she expected restrictions to remain in place until basically vaccination in May and June. So some of that local services optimism that we saw in Western Europe and the US should be replaced by skepticism that you're going to have a full return to demand, which is of course very unlike the experience in China, New Zealand, and some of the cases that actually got COVID under control effectively. So expect this pattern to continue, and this pattern consumes a lot of corporate time, especially when we're talking about Western Europe and the US, two of the largest overall economic regions in terms of total revenue generation for multinational companies. In Asia Pacific, what we talk about this dancing idea, what we mean by that is that as COVID waves increase, how effective are local officials at getting those COVID waves under control? So the dance is this process between as COVID cases rise, you tighten restrictions, and then as COVID cases fall, you loosen restrictions. The idea of that is to minimize the economic and social cost while controlling the disease effectively. And you can see from this sort of basic heat map of strength versus weaknesses, broad strength in the dancing abilities of Australia, China, Japan in large part, Singapore, South Korea, and Vietnam in general. The main hits against Vietnam and China is just that their healthcare infrastructure and resources are limited compared to some of the larger spends of the Australias and Japans of the world. But you see here clear weaknesses in some APAC portfolio countries, India, if it's including your APAC portfolio, Indonesia, and Pakistan being very weak, and the Philippines and Thailand also showing a lot of weakness in these fields. And so a very clear bifurcation of where corporations have to plan around these sort of COVID waves. Because when governments can effectively treat the disease locally, it becomes less of a problem of risk mitigation from corporate planners. The volatility is simply lower. Thinking past COVID, and this is going to be something which really starts to consume strategic planners' attention. We've already seen it start to happen. A lot of companies have shifted their business practices or shifted their product portfolio, shifted their channels, or shifted how they sort of manage and deal with distributors as a result of COVID, clearly with some very big industry level specifications. What people are obsessed about is what post-COVID, which of these trends are here to stay and which are not, right? In what ways will domestic societies return to normal pre-COVID, and which ways have domestic societies evolved? And these are all debatable, and we won't go through all of them in depth, but the point here is that we're very clearly starting to see some people begin to think that some industry groups are in structural decline and that COVID has basically accelerated ongoing changes in how business planning and consumer strategy worked. So we expect a decline in business travel due to the widespread availability of fast internet, voice programs, programs like GoToMeeting, which allow for webinars and for corporate planning to happen that way. And that reduces resource costs by the firms, as well as increases overall efficiency in many ways, with, of course, costs for business travel. Physical goods, retail, non-food, that's simply a shift of channel, right? As people have gotten used to using online and digital channels, partly because of COVID, you pulled in a lot of adopters who didn't use those channels before. Older people who couldn't go to the grocery store in Western economies, people who didn't know you could order pharmacy goods online, telehealth. And now that those things are available, we do see a sort of structural decline in retail storefronts as a result of that. And we can go on and speculate about whether or not we'll ever be back in offices the way we were before. And in fact, a lot of companies are trying to figure out the offices of the future. What do they look like? What do we have to build that our employees want to use that makes them as productive, if not more productive, than staying in their homes? And so this is also consuming a lot of attention and time at the top. And as much as possible, realizing there are regional differences and country level differences in how this plays out. There's going to be a sort of desire for back and forth conversation to make sure that corporate planners don't implement a one size fits all policy across their entire portfolio. In terms of the growth recovery, APAC is by and large, well, by far doing the best in terms of GDP. So this is basically how we're looking at when do countries get back to pre-COVID levels of GDP. index activity. And APAC recovers in 2020, largely due to the significant recovery of China, which has basically supported a lot of the underperforming countries in APAC, which we'll see in the next slide. Much more macro stability overall, as well as the large growth rates that we had entering into COVID, providing a buffer as they recover to rapid growth. Your laggards here are going to be a lot of developed markets and then commodity-centric emerging markets like the Middle East, largely due to our view on commodity prices and the need for fiscal austerity due to weak oil revenues. So a lot of bifurcation, but for this reason, corporate executives will once again look to APAC and try to figure out, can we actually get significant bottom line improvements from our APAC business, given the recovery and growth and given the revenue projections, that will be able to offset the weaker revenue streams we have in large parts of the rest of the world, which is, again, an uncomfortable position to be in APAC, where we have very high levels of competition, which reduces margin.
Yeah, I'd actually like to jump in here really quickly.
Please.
So very often this chart gives many executives in Asia Pacific grounds for, it prompts them to breathe a sigh of relief, because they look at that and say, oh, we're going to be fine, it's all good, we don't have to worry about anything. But we've actually seen rather different dynamics emerge. And Ryan, I'd love to hear if you've heard anything from the individuals that you speak with in HQ about this. But speaking with executives in Asia, what we've heard, particularly at the regional executive level, is that very often corporate sees this line and says, well, the entirety of Asia is fine. And so you all shouldn't be talking to us about risk or problems. You should be talking to us about growth. And by the way, growth that enhances our bottom line, because that's really what we care about right now. And of course, the picture is much more complex than that. But there's less willingness to listen right now because of the general impression that Asia Pacific is doing well. And then on top of that, as Ryan mentioned, and as I alluded to, there's so much greater focus now on bottom line growth than we've seen in the past in Asia. And that, unfortunately, in many cases does not, it marks a change in the dynamics that executives are facing, not just at the regional level, but even at times at the country level, even though some country level executives don't necessarily see it coming or understand the underlying dynamics behind it. So we are in Asia at the same time as we're seeing a lot of faith and confidence in growth, also seeing less willingness to discuss the complex dynamics underpinning those numbers, and a much greater emphasis put on bottom line growth than we've seen in years, perhaps ever.
That echoes exactly with what I've heard from people I've talked to, sort of at the global HQ level, which is an uncomfortable position to be in, and will continue to create tension as we go forward this year, I'm sure. I'm not going to belabor the country level dynamics here. This is not a global economic presentation of the Asia region, but the point here is to note that a lot of this recovery in that sort of top level graph, that graph before has resonated very strongly with people in global HQ as a frameworking mechanism. A lot of this is being driven by China and to a lesser degree by Vietnam, just in terms of the roll up. And so when we look in aggregate, the region looks very good, but obviously, as everyone in this room knows, the underlying drivers in a country like China, especially with the types of stimulus it enacted this year, is going to show very different dynamics across industry, as well as across country when you compare it to an Indonesia or a Japan or a Philippines, which have done sort of much worse this year. And so it creates a lot of noise when we're trying to create one clear message. And also the risk profile as a result, as we just talked about with different COVID rates, is distorted by this as well. The sort of volatility that you would put on the growth is very different in these countries. Chinese growth is very unvolatile due to state planning. Indonesian, Philippines, Malaysian growth is very volatile and will be throughout the year. And so that's a key risk that people are paying attention to. Just continuing on, this economic recovery will take several years for many countries to get to pre-COVID levels of growth, aggregate demand in this case. That means a few different things for these laggard countries, which won't recover until 2022 or beyond. Again, we're looking at Saudi, but we're looking at countries like the US as well in sort of the 2021, 2022 bucket. Germany in late 2022, much of developed Europe in 2024 plus with France, Italy, Mexico. Again, these are a lot of the historic sort of profit drivers of global businesses. And the long time it takes to return to a full recovery means you're not going to be able to get pricing premiums in a lot of these countries. In many cases, you're actually going to see cutting of margin in order to just maintain consumer base, or sort of higher competition due to a lack of overall real demand. So again, what that means is that people are going to be looking to some of these early recovery countries more and more to try to pick up some of those economic losses. And again, China, Vietnam falls in the 2020 bucket, Taiwan, and then 2021, you get Malaysia, South Korea. And so this is something to watch as well, because the longer it takes to recover to pre-COVID levels, the more vulnerabilities are built within the country. That means revenue shortfalls of tax base, and that means sort of unhappy consumers. And we're going to really turn to some of these risks next. So from a corporate planning perspective, there's government level shocks that we think are quite likely. And these are actually our base case. And so they're not risks in the same way, but these are significant changes in the domestic political profile. And so when you're a large multinational managing all these countries, trying to figure out where to spend your priority dollars for marketing, things like this are going to pop up as concerns. So we do expect that weak revenue and sort of higher spending in 2020 and into parts of 2021 are going to lead to fiscal spending cuts in many countries, especially in the emerging markets. So anything red here means that we expect fiscal spending decreases. Most of Latin America, large parts of the Middle East, India, large parts of sort of Russia, Central and Eastern Europe. The logic behind this is very simple. Countries spent additional money on COVID-related measures, on social spending measures to support consumers and firms that were losing their ability to survive. To keep them alive, to keep them satisfied, countries spent more. But as we go into 2021, the higher levels of debt now mean that countries don't want to keep doing this going forward. So they're going to cut spending. This will impact each country different ways. And so you really have to focus on each country's own political process, which is a big time sink, which is part of the service we offer, of course. But one of the things that you see repeatedly pop up is that government spending is leading to changes in how governments are opting to spend. And that's often happening at the agency level. So cuts happen to overall medical spending, and the Department of Health has to figure out what we're going to do in terms of procurement. Or cuts happen at the level of social spending en masse, and that just means that lower income consumers in aggregate just have less money to spend. And so we're seeing both of those things play out, which obviously have different implications for different industries in all those countries. The flip side here is we do see some fiscal spending increases, mainly in some developed markets. So obviously US, Canada, Western Europe, China, and then sort of large parts of Southeast Asia. We do see some moderate fiscal spending increases taking place as well. So bifurcated picture, but one of those points that corporations are looking at in terms of trying to set targets that builds the expectation in green countries that you're going to have more stable demand. Of course, if those things change in different ways than we expect, then that's going to lead to it should lead to a rethink in demand targets. We also see countries passing tax increases. And again, this is because due to the COVID situation, you had a revenue shortfall as well as higher spending increases. So many countries are at the same time as they're cutting spending, increasing the tax rate. And that's what we see on this map. So in yellow, orange, and red, what we see are yellow are corporate tax increases, orange are consumer tax increases, and then red is both. In APAC, very few countries are passing tax increases as we expect it right now, with the exception again of sort of India and Bangladesh. What we are seeing across most of the rest of the world is some combination of consumer taxes, often VAT taxes, and corporate taxes. In the US, we did not expect any tax increases, but following the surprising victory of 2 Democrats in the Georgian Senate race a week ago, we flipped our view to expect both corporate and consumer tax hikes. We don't think that's going to impact how executives think about the US as a priority market in 2021, but it does change the profit outlook for some of the sort of impacted industries. And then FX depreciation is also top of mind, especially in countries outside of China or outside of controlled currency regimes. The risk lock here is very much that higher fiscal spend during COVID, collapse of revenues, plus a long time to recovery for a lot of these countries increases the risks that international investors will get panicked and start to dump currency over risk concerns. And so we've seen that game play out during every recession in the past. We saw a lot of rapid FX depreciation in 2020. We saw it in Indonesia, we saw it in India, but a combination of factors meant that those currency depreciations were largely unwound and did not lead to massive crises in 2020. But that risk is not gone. And corporate treasury, CFOs in particular, often are very concerned about mitigating the risk of large swings in FX, which could happen in 2021. Again, just looking at the map, the main concerns here are going to be free floating currencies in Latin America in terms of major FX depreciation against the dollar. There is the opposite concern as well. The US dollar has been depreciating for about 6 months now, incrementally over time, especially against large trading currencies like the Japanese yen and the euro. So for exporters to the US that index in Japanese yen or in terms of the euro, that has been a concern about trying to target the exchange rate. We've had about an 8% depreciation this year already, or last year. And the concern, of course, is that an 8% depreciation is basically an 8% decline in margins for countries that index in the yen or the euro unhedged. So that is also consuming a lot of sort of time and concerns from the top. So the US dollar goes both ways in this one.
Ryan, just really quickly, one thing that's notable about this slide is that we're really looking at the likelihood of a significant depreciation. Significant depreciation being more than 10%, a shift of larger than 10%. You know, if I look at Asia here, it looks pretty green, which on one level may give me a sense of comfort, but it's also notable that our benchmark for coloring any country here a shade of orange or red is pretty high. So when we look to the future, when we look to next year, and we think, I guess, in less stark terms about depreciation or appreciation risk, I mean, would you say that there's significant risk of volatility below the 10% threshold?
Yeah, so it's a good question. I do think the renminbi continues to be overvalued, especially when you look at it in terms of in trading terms. So I do think that you're probably likely to see, depending upon what the Biden administration does in its early months, if it maintains constant pressure, I think there's good potential for a moderate appreciation of the renminbi, simply because the level of overvaluation currently by trading metrics is pretty stark. There's some other things too happening. And so we already know from early in the Biden administration, we'll point to this in the next slide, that the pressure on Asian countries to alter somewhat their trading relationship with the US, that pressure will continue. And I think another one that's likely to look at would be Vietnam, where we might see further allegations of currency manipulation that might lead to the need for the country to appreciate the currency somewhat. So those are two that I would point out. I think in terms of volatility and moderate depreciation, any of your Asian markets that see large second waves of COVID, that have delays to vaccination rollouts, or that have big political risk swings, you're probably going to see a big currency, at least a temporary sell-off. And again, I'm thinking about India here and Indonesia in particular. And that doesn't mean a 10% for the entire year. It means like maybe you break above 10% for a day or two, and then you return to an 8 to 5% depreciation. So as I just sort of hinted at, there's a lot of politics that are backing this, and so we do have a Biden administration. That's top of mind for a lot of people. What is the Biden administration going to do? This is part of a report we did a few months ago on the electoral outlook, where we did expect a Biden victory. In APAC in general, the thought process here is we expect Biden will return to mostly Obama-era strategies of building trust with the wider region. So India as a strategic partner on a medium-term basis, try to get better working relationships with sort of Vietnam, Indonesia, South Korea. Not what the Chinese fear as much as an encirclement strategy, but more of a sort of return to the spirit of TPP, where the US tries to build a regulatory regime which is more friendly to US regulatory norms and can be a counterweight to Chinese regulatory norms. But we do expect a sort of hawkish maintenance of the US-China relationship. That doesn't mean more tariff hikes, and as we'll talk about, there is potential maybe for some moderate improvement in that relationship. So finally, with much buildup, we can talk about some of our headline risk. So again, to think at the beginning, we talked about COVID direct risks, we talked about indirect COVID risks to some degree. Those are probably the 1 and 2 top of minds right now for corporate planning and for local strategy. But event risks are important. And so we do this report every year to help discuss event risks with corporate planners to make sure that they put contingency plans in place and they have the thought processes in place. I'll just walk you through our methodology on the live slide in a second. But basically, this is a sort of large internal process which takes several months for us to identify key risks, weed them down to what we think are the most important risks for corporate planning, and then sort of develop scenarios to help guide the development of contingency plans. We always do a retrospective to see how we've done, to see if we can improve our ability. The main thing we don't want to be is surprised by events breaking out that we didn't expect. We did not expect COVID-19. It wasn't a defined event, but the risk of a pandemic is always on long-term disruptors of potential, but that doesn't mean that you can always plan for those, right? Those are a little bit too esoteric. But looking at 2020, we did sort of correctly identify some of these low-risk events happening. Extension of the U.S.-China trade war into more of an economic Cold War. The onset of a U.S. recession, Eurozone recession due to the long business cycles. The defeat of Trump by sort of a Democrat in this case, which was our upside event. So looking at our 2021 events, it's a narrow list, again, partly because corporate planning is so focused on COVID and partly because of the sort of transition to the Biden regime and the impact that has on limiting some of the event risks that we'd normally see in sort of a later year of a Trump administration, which was very sort of risk prone. To briefly just sort of read over these events, the vertical bar there is how long it takes for an event to occur, the velocity. And that velocity is important in terms of how you plan. So if you only have a few days to plan, as in the event, the sort of widespread emerging markets debt and currency crashes, that can literally happen overnight. And so unless you basically have plans in place ahead of time, you won't be able to respond in real time. And so for one way, that compels that event to be one of priority for corporate planning. Longer term events like the US retaking the leadership role in climate change, that one will take place over weeks and months as sort of negotiations are held. You can read the plans that are ongoing, and then you can assess the impact on your business. And usually there'll be a delay between agreement on any sort of climate change relevant legislation and when the implementation date is. So it provides more of a sort of landing pad for corporate planners to adjust. And then the bottom axis is how likely we expect the risk to be. Again, these are not our base case, so these are low likelihood events, less than 50%. But you can see here what's more or less likely in our minds. So US retaking a leadership role in climate change with the Biden administration and the Senate victories has increased from a 15% to a 30% in our likelihood. So we do expect significant climate action to take place. That's very different from low risk events like anti-vaccine backlash to those adoption rate, which is where basically individuals refuse to take COVID vaccines to such a degree that it delays the ability for countries to achieve herd immunity and therefore delays the return to normal local services provision and tax bases. So what we're going to do for the next couple of minutes is basically just walk through some of these events that we think are most important for this audience and for corporate planning. And of course, we can answer questions on the remainder at the end. So the first one I want to touch on is widespread emerging market debt and currency crashes. This is an example template from the report. Again, email your client services associate if you want to get access to this report. We don't have to go through the entire thing, but these scenarios are designed to help with planning. And so the downside event here is widespread emerging market debt and currency crashes. And what we mean there is contagion. So basically a massive market risk-off event, which rejects currencies under pressure, like a return of pressure on the Indian rupee, but that leads to a widespread sell-off in unrelated currencies just because they're perceived to be risky. We've seen contagion events in the past. We don't expect that to be the case this year. Our base case is relatively stable exchange rates and sovereign debt yields, maybe with some isolated currency crashes that are locally contained, as was the case of Argentina a few years ago, or Turkey a few years ago. There is an upside event here as well, and that's sort of a massive rally in emerging market assets, including currencies and bond yields. And the problem is on the risk balance, both these are possible to the upside or downside. So preparing for this situation is almost thinking about internally, what does a 10% appreciation or depreciation of my currency mean for my business? Again, even if there's not risk drivers related to local activity, but because of its stature as an emerging market currency, which can show this sort of exceptional volatility in a year like 2021. Sometimes this leads to hedging strategies. Most often it leads to conversations around making sure your contracts are appropriately indexed so that major swings in currency or major changes in nominal prices that you pay for inputs, some flexibility is built in for massive swings away from the median. And that's one defensive strategy we've seen corporations seek to implement as a result of discussions around these events.
Yeah, I'd just like to dig into this a little bit more. So to repeat what Ryan said, what's notable about the downside here is that it represents contagion, right? So if we think back to that map, Asia Pacific as a whole looked pretty green outside of South Asia. But that doesn't mean that Asia isn't potentially exposed in some ways to this idea of contagion, right? If we think back to past events where financial markets or where effects have rippled through financial markets in ways that were not really that well understood, we may very well be in a similar situation. Similarly, it's important to note that this would not lead to universal depreciation across Asia. Currencies like the Japanese yen would rally, they would appreciate in this sort of situation due to a flight to safety. So it's critical to understand the varying dynamics across markets, and that's something that we can discuss in a separate session. But Ryan, I guess my question for you on this particular event is, are there any potential trigger points that you could point to, or are there any potential events that might tip things over the edge into a downside scenario?
Yeah. So there's a few, we try to identify these in signposts, but a few that sort of pop up is, number one, any major FX depreciation that comes from a massive spike in COVID-19 or massive fiscal cuts that leads to widespread protests. So we've seen some of those in India, we've seen a lot of them in Latin America before. But I think the more sort of subtle ones, which are probably more likely, would be concerns about a more rapid path of US federal rate hikes. As soon as the Federal Reserve gets serious about hiking rates, you're going to see a risk-off trade hit the markets, which could impact a lot of emerging market currencies and sovereign debt yields. Similarly, if China starts to really get serious about pulling back its fiscal support or tries to increase its reserve ratio, you could see the same thing happen. Again, I think those are low probability events for this year, and I think that international market panic would be taken as a signal by the Fed to return to a slower path of rate hikes that we expect. But that would be a main source of trigger.
So basically a taper tantrum redux.
Exactly.
Got it.
So I guess moving on to the next event, which is probably top of mind, is US-China. We've done a lot of work on this, Adam and I and some of the rest of our teams. And obviously we can't do a full US-China presentation here. Here's our basic base case, and then here's what we're identifying as our both upside and downside. We do expect the US-China we expect the relationship to retain some of this elements of strategic competition that's really emerged under the Trump administration. Elements of that were also seen in the later Obama years. And so we think that national security concerns around US export of intellectual property to China will continue. And so we do see ongoing restrictions of that kind of sort of IP and technology. And we think that's the semi-permanent feature of the landscape. Being said, Biden has said before that he doesn't like, especially the later rounds of US tariffs on China. They were meant to be punitive on China, but what they actually do is hurt US consumers by making import goods more expensive. And as we've seen during COVID, the US-China trade balance widened substantially because US consumers were stuck at home, and China produces those types of goods that US consumers consume at home, durable goods. And there's no real strategy by the Biden administration to try to really bring that kind of, manufactured goods back to the US. So while we expect there to continue to be a level of tensions, we do think there's an upside possibility of a partial reset in which some consumer tariffs are lowered, especially the later rounds on textiles, sneakers, and some of the light consumer goods. So we think that's an upside potential. And that would have to come with further rounds of US-China talks that leads to some sort of increased market access for US firms, or promises from the Chinese government that are credible on other issues that have plagued US businesses operating in China, like forced technology transfer. So there's an upside possibility there. We also have the downside event, which is kind of China's worst fear. The US increasingly treats China as a strategic adversary, really seeks to limit bilateral flows, including of people, and tries to build some sort of a multilateral coalition against the Chinese. We put that as low likelihood. But again, I think this is probably top of mind, and our base case here very much is ongoing tensions. Adam, I'm sure you have a word or two to say on that one as well, but we'll probably have to do another webinar of this in short order anyway.
That's all right. Yeah, I'll just add one quick thought, and then Ryan, I have a question for you, just from the US perspective. So the item that I want to just re-emphasize here is that our base case is by no means a return to status quo of the Obama years. Right? Our base case, the reason that our downside scenario probability is as low as it is because our base case marks a slight decrease in tensions, but no major changes to the policy environment, at least not immediately. If we had reframed that a little bit differently, then it would probably change the likelihoods that we've assigned here. Having said that, as Ryan noted, there's a lot to discuss here. This is a webinar in and of itself. So I'll make sure I'll stop my commentary with just a quick question, Ryan. From your perspective, if we look at the likelihoods and the upside versus the downside here, it looks like you have slightly tilted towards the upside out of these three. Presumably that's more due to perspective on the Biden administration than on the Xi administration. So I'm curious to if you could just outline a little bit more of your thinking on that front.
Yeah. So the Trump administration was really staffed by an economics team that believed that tariffs were good in and of themselves, that tariffs were good. And that is a routinely and regularly rejected assertion by almost every mainstream economist in the world. Most mainstream economists believe that trade is good in general, and that trade is normally mutually beneficial as long as there aren't too many distortions put in place by either country that makes the terms of trade unfair. So what the Biden administration wants to do, especially again in non-national security centric trade, so again, we're talking about sort of mature commoditized products here. Consumer durables, household electronics, any sort of textiles that are still produced by China, sneakers, component parts that are that are commoditized, screens for electronics. The Biden administration would love to get back to a place in which they can drop those consumer tariffs and allow the trade of goods to come back to the US, because again, US consumers are still purchasing them, and US firms are not sort of clamoring to produce them domestically, because in most cases the margins are pretty low in the US just due to the high cost of labor here. And so what you're really asking US firms to do is to find alternate markets in the world outside of China to produce and ship in those same goods. And China has a lot of benefits. Factories are already established there. People know how to do business in China. It's a massive labor force. So that's what they want to get back to. The question is, how can the Biden administration do that without inviting allegations, number one, that they're being soft on China, and number two, how can they do that while also partially addressing the legitimate concerns raised by the U.S. Trade Representative's 232 report from a couple years ago, which is some of these sort of Chinese business practices that have led to a lot of pushback by these firms and lobbying by these firms on the U.S. to do more. Again, forced technology transfer is one of those, but one of many. And so that's the problem, is that the Biden administration has to get some sort of an agreement out of the Chinese, who obviously at this point feel like they already agreed to a phase one deal with the Trump administration that the Trump administration didn't uphold its part on. Neither did the Chinese in terms of purchase commitments for that matter, but it's sort of a situation which has to be negotiated through. So that's the basic outlook for that one. Will it happen this year? We're not sure, 20% likelihood, but should corporate planners be aware that they might be able to restore the normal export of goods from China to the US this year? They should be, because it changes how much they should focus on finding alternate production sites for those kinds of products. And so that's the real reason we're flagging it here. And it's also a defense argument for Chinese-based producers or organizations that want to tell their corporate headquarters, no, you should still look at China for a lot of advantages, plus the tariffs might not be here in the future. I think that's true as well. I'm going to quickly move through sort of one or two more sort of little slides here so we can have a few questions if we can. The first one is about oil prices. We do expect range-bound oil prices this year between $40 and $60, with an average now of 55 for Brent crude. We do have an event tied to this, because obviously oil prices are a very major import cost for most Asia-Pacific countries of size, and a massive increase in prices of oil is going to lead to strapped consumers, high rates of domestic inflation, and general underperformance of the consumer economy, as well as for some fixed investment. It could also put pressure on the currencies, as we talked about before, especially in the case of India. We do not expect prices to break out much above $60. We have the rationale here laid out. We have pretty good confidence in our base case of around 60% likelihood of range bound, 40 to 60. We actually do see a crash lower as being relatively likely. But I would say that in recent weeks, especially with the moves by Saudi Arabia, the upside risks to an oil price surge have increased by the back end of this year. And that's because Saudi Arabia has cut production in order to push up prices, and an early surge in recovery of mobility has led to a big depletion in global oil inventories. Still near 5-year highs, but they've declined pretty substantially in January. And so oil prices have moved up as a result. And so this is something that people should be aware of and prepare for. We've had plenty of examples in the last decade of how consumers respond to surges in local oil prices. And so there should be ample evidence to draw upon to figure out how will consumers adjust spending, how price sensitive will they be, how will they switch their mobility options as a result. And so it's just something that I think we should be aware of. It's actually still relatively inexpensive to hedge at this point. And so a lot of B2B companies have already sort of looked at back-end hedges for this year as a means of limiting that upside risk. And then finally, I just want to sort of leave us on a note of regional drivers before concluding. We do outline some Asia-Pacific events to watch for 2021. A lot of these events are evergreen. And the reason for that is because these are low probability events that are mainly related to security issues, which sort of have not resulted in some cases in the massive explosion of risk that one might expect. So one that we always have to talk about is often brought up is military confrontation across the Taiwan Strait. Recent actions, recent difficulties between Hong Kong and China have led to more questions about Taiwan that are inbound. Again, we think it's a low probability event. It doesn't mean that it shouldn't be in the back of the mind for corporate planning. It's mainly kind of an insurance type question in a lot of cases, but these are the kind of questions that we tend to focus on here. One I do want to note here is North Korea tests Biden. We have that as a very high likelihood. We've seen increasing chatter out of Pyongyang about this, and the sort of North Korea tends to do this whenever new presidents are elected, especially in this case where he had such a favorable relationship with Trump. With the Biden administration coming in, he is under the perception that some harsher penalties might be coming, and certainly a less sort of cordial relationship. That doesn't mean that North Korea is going to nuke the US or anything like it. It means that you may have a return of some missile launches as test experiments. That can create some panic and create some risks of supply chain disruptions sort of between Japan and China. But there's simple steps that one can take to just do basic preparation. For instance, do you even have a security measure in place for your South Korea offices to account for your office staff in case something happens and people are missing? That seems very, very sort of almost beyond the pale in terms of discussing risk, but it is something that I think that you can take little steps to sort of build up to the implications that North Korean missile launches as a challenge to Biden are quite likely in our minds the next year. So just to conclude here, I realize we're out of time, Adam.
Yeah, let me just make one quick comment. With regards to the security-oriented events, we are, and Ryan's just going to talk a little bit about contingency planning in a moment. We're not sitting here suggesting that companies should build plans for each and every one of these events. They're evergreen in many cases. They're constant low-lying risks, but that doesn't mean that they are not risks. There's a tendency, just because something is there constantly and low-lying, to begin ignoring it and think that just because it hasn't happened in the past, it won't happen, and that is a mistake, right? So as you look across this list of risks, if there are areas where you are particularly vulnerable, so take the military conflict across the Taiwan Strait. If your business is incredibly vulnerable to supply chains running through Taiwan, this is something that you should at least be thoughtful about. Once a year or more frequently, revisit this and consider, even briefly, what would happen if. Because this exercise alone will greatly benefit you should the unthinkable happen. And we've seen this over the course of this year, or last year with COVID, just continue to play out.
Yeah, thank you, Adam. So I guess just to conclude here, I realize we're at time, but we will probably take a few questions here after this. Contingency planning, we think, is critically important. We've done internal surveys and analysis that show the benefits in terms of top line and bottom line growth for companies that engage in this sort of planning. And during a year like COVID, you have to be relatively proactive about this. And so that's where the advice that we give is at least discuss these events in some sort of structured framework. And then as much as possible, identify, as Adam said, the so what, now what. The now what is the plan, right? It's identifying, in this scenario, what do we do? And simply having that written down once, we think builds sort of the reflex that makes it easier and more rapid to get groups together to respond to some of these fast moving events. And because so many planners now have experience with this from COVID, it's almost locking in some of that institutional memory of the experience of the last year or two. in order to identify some of these sort of medium-term events and try to identify how you'll respond if these break out this year. So that's a large part of these exercises. I guess, Adam, at this point, do we have any questions from the audience that we want to take? I realize we're at time, but we're going to probably take a few before we answer the rest sort of over email.
Yeah, we do have some questions, and I know we are running over, so we'll just select a couple of them. And if incidentally you have any questions that you want to send over, by all means, please do so. We'll follow up via email afterwards. And if we don't get to your questions, we won't get to all these questions. We will also follow up. But two quick questions. So Ryan, we got a question about the event U.S. retakes leadership role on climate change. Could you briefly go into a little bit more detail on that event?
Yep. So this event was increased substantially after the win by the Democrats in the Georgia Senate, which gives the Democrats a majority in the House, Senate, as well as the presidency. Biden has already appointed a special advisor on climate change, John Kerry, former presidential candidate. He's very serious about addressing climate change, and that's a sea change for the U.S. It aligns very closely with what the Europeans have focused on for years. So what does this mean? There's both domestic and international implications that are yet to be spelled out. Domestically, we do expect changes to be made to regulatory standards for things like fuel efficiency. We do expect infrastructure spending to come out with a focus on green infrastructure. So either grants or tax cuts for development of technology and the purchase of sort of nascent or mature technologies that are green in orientation. Solar panels being an obvious one, expanded wind turbines, green requirements for grid purchases, things like that. That will take place. More energy efficiency standards in terms of appliances, building code restrictions happening at the state and local level, building on this. The international aspects of this are a little bit more mixed. The concern is being held by many that the Biden administration is going to put climate change at the center of its foreign policy in some ways. So this concerns countries like Brazil, which are notoriously ungreen compared to most of Latin America. And will the Biden administration force changes to be made to domestic law to make the country more green, right? Less carbon emissions, better sort of a path towards lower carbon emissions in exchange for striking new deals in terms of new trade deals, regulatory deals, things like that. I think the latter risk is live and something that people should be concerned about. It actually also, ironically, sort of creates one path of opportunity for the Biden administration to re-engage with China, which in the years since the U.S. last really took climate change seriously, has had a rapid domestic change within China towards pursuing a much more sort of green regime as well. So I actually do think that creates a point of mutual interest that the Chinese, the Europeans, and the U.S. might be able to work together. And so that's why we have it as an upside event. Obviously, some industries are hurt by this, but overall, we think it's actually a positive both for the world as well as for U.S. relations with the rest of the world.
Gotcha. All right, one more question for you, Ryan, before we wrap up. I think this one will be actually of particular interest to anybody focused on China and particularly in China. So Joe Biden will take over the U.S. presidency in just under a week. We're now starting to see his appointments to key foreign policy positions making their first policy statements. As a result, has anything changed with regards to your perspective on the future of U.S.-China tensions?
That's a good question, and it's something that we're going to keep updating on. The short answer here is no. So as Adam noted before, we've sort of staked out a pretty sort of bearish outlook on U.S.-China trade and exchange because of our view on the national security implications of IP and the seriousness with which the U.S. government's taken that. the Trump administration tried to paint Biden as being soft on China, and we never thought that would be the case. And the initial statements made by his U.S. trade representative appointment, the statements that were read by his sort of State Department appointments, some of his other decisions at Treasury, no, I think it largely confirms our case. And so what that confirms again is a sort of corporate mandate to think strategically 3 to 8 years out about, how you want to design your U.S.-China supply chains. And so I think that's a larger conversation, but the short answer here is no, it really doesn't change the way we're viewing it.
Excellent, excellent. All right, well, we're a bit over our time limit for today's webinar, so we'll wrap it up here. If there were any questions, there were questions that we were unable to answer on the line today, we'll be sure to follow up with responses via your client services manager. Also, everyone on the line will receive a recording of the presentation within the next 24 hours. In the meantime, you can view these webinar materials and much more on our new mobile app, which is available for download right now on iOS and Android. For complimentary access to our suite of resources, including data, dashboard tools, and market monitoring reports, please email us at info@frontierview.com, and a member of our team will be in touch. Thank you, everyone on the line, for joining us. This concludes our webinar for today. We look forward to speaking with you again soon.